Goldman Sachs, UBS, JP Morgan, three of the most powerful banks on the planet. And they have all said the same thing about the same asset in the last 48 hours. Same conclusion, different reports. And I have every single one of those documents right here because I spent last night going through them, cover to cover. So, what is the asset? I will get there. But let me tell you what is actually happening first, because the setup matters. The world's central banks, the boss banks, the ones that literally control a country's entire money supply, are selling U.S. government debt, actively, and replacing it with one specific hard asset. At the same time, China's central bank has now bought that same asset for 15 consecutive months. Not 15 weeks, 15 months. And Goldman Sachs has a year-end price target on this thing that represents a 15% move higher from right now. But here's the part that gets really interesting. While Goldman and UBS are telling their wealthiest clients to stay bullish, the institutions are actually selling at levels we have not seen in years. So there is a gap between what the research says and what the money is doing in the short term. And that gap is exactly where the opportunity lives. The asset is gold. And if your savings are sitting in a standard account right now, what I am about to show you should make you genuinely uncomfortable. Here is the uncomfortable math. Your savings account, if you are with one of the better online banks, maybe pays you 4%. If you are with a major retail bank, you are probably getting 1%. Meanwhile, the government tells you inflation is running around 5% a year. At 4%, you are already losing ground in real terms. At 1%, you are getting quietly destroyed every single month. And here's what I actually want you to think about. The US dollar index dropped from 109 to 99 over the last 12 months. That is a 9% collapse in the dollar's purchasing power against other major currencies. In 1 year, you felt that. Every time you filled up the car, went to the grocery store, renewed your insurance, you paid for that 9% with real money out of your real pocket. The official 5% inflation number, we all know that understates what most people actually experience. The people who understand why this is happening structurally, not just because of news cycles, those are the people who are going to be okay. The people still waiting, they are going to look back at this period and wonder what exactly they were waiting for. So, gold hit an all-time high of $5,589 per ounce in late January 2026. Think about that number for a second. 5,589. In 2025 alone, gold set 53 separate record highs and delivered over 60% in annual returns. The metal more than doubled in under 2 years. And then March 2026, worst month since June 2013, down more than 10% in 30 days. And I will be honest with you, when I first saw that number, I thought the same thing you probably thought. Something is wrong here. The story is changing. It wasn't. And the reason it wasn't is something called a liquidity squeeze. Understanding this is probably the most useful thing you will take from this video. Here is what actually happened. Step 1. The US-Iran conflict escalated on February 28th. Oil surged. Inflation expectations jumped. That pushed Treasury yields higher and strengthened the dollar in the short term, both of which are headwinds for gold as a non-yielding asset. And the big leverage funds that had been sitting on massive gold positions all through 2025's rally. Suddenly they had losses piling up everywhere else in their portfolios, everywhere. Equities, bonds, everything except energy. Step 2. Approximately $14 billion came out of US gold ETFs in a compressed window. The investor category called Manage Money cut their gold exposure by about 22 tons in the same period. Then the algorithms detected the downward momentum and piled on with their own selling. Step 3. Gulf states, whose oil revenues were getting squeezed by the conflict economics, started liquidating gold positions to cover budget shortfalls. Another wave on top of the first two. None of them, not one, made that decision because they thought gold had stopped being valuable. They sold because they needed cash. Right now. Urgently. And gold was the most liquid thing they owned. Let me put it this way. You own a workshop with high-end equipment, a precision machine that took years to acquire, fully paid off, worth more today than when you bought it. Then your biggest client cancels their contract. Payroll is due in 2 weeks and you don't have it covered. So you call the equipment dealer and you sell the machine. Not because it's broken, not because it lost its value. You sell it because you need liquidity right now, and that is the fastest way to get it. The quality of the asset is completely irrelevant when the cash need is immediate. That is exactly what happened with gold in March. The equipment was fine. The owners just needed cash fast. Let me explain why the March selling got so violent. Because this is the part financial media tends to skip completely. Hedge funds run leverage. A conservative hedge fund uses 5 times leverage. The more aggressive ones, 40 times. So think about what 40x leverage means in practice. The market drops 1% and you are running 40 to 1. You just lost 40% on that position in one day. You can see why they had to react immediately. They had to close positions before the losses compounded further and wipe them out entirely. And look, I know some of you are already mentally setting up a GoFundMe for these hedge funds. The second yacht, the 7-week vacation. Very serious situation. But all jokes aside, the point is, these funds cannot hold through volatility when they are leveraged that heavily. They sell what they can sell, not what they want to sell. Gold was liquid. Gold got sold. Goldman's own research note put it plainly. They said persistent disruption to the Strait of Hormuz kept gold vulnerable to further liquidation. That is Goldman's language. Not vulnerable to losing its fundamental value. Vulnerable to liquidation. That is a very different statement. Now there was a secondary story running through financial media, suggesting Gulf states were dumping gold reserves and making the sell-off worse. Partially true, but it's more nuanced than the headlines. Gulf states were dealing with something specific. Their oil revenues, primary income source, were being compressed by the exact conflict that was sending oil prices higher for everyone else. Budget shortfalls appeared fast. Some Gulf sovereign wealth funds moved gold to cover those gaps, but they were not abandoning gold as a strategic asset. They were using it the way a reserve asset is designed to be used. The thing you draw down in an emergency because everyone accepts it instantly without negotiation. Think of a business owner drawing down a credit line in a rough quarter. You use the line because it is there and flexible, not because the business is failing. And here's the thing. When a sovereign wealth fund has an urgent cash need, the first call goes to the gold desk, not to the warehouse full of copper, not to some illiquid alternative investment, gold. Because every institution on earth accepts it, prices it, and moves it within seconds. The fact that Gulf states turn to gold first is not a weakness signal. That is a proof of value statement. You can only use something as emergency liquidity if the entire world agrees it is worth something. Gold passes that test every single time. So, what is the real-time institutional sentiment data actually showing right now? On a scale from 0 to 100, where 0 is maximum selling pressure and 100 is maximum buying, the current reading sits at levels we haven't seen since 2022. Deep in sell territory. Really deep. Institutions are as heavily positioned against gold as they have been in years. And historically, over the past 3 years, every time this score hit these extreme lows, gold averaged an 18% gain over the following 90 days. Every time. Past performance, I know. Put the disclaimer in the comments if you want. But 18% average returns following maximum institutional selling is a pattern worth understanding, right? Now here's the really interesting part. While Western leveraged funds were selling in a panic, while that sentiment score was bottoming out, China added $1.9 billion in gold ETF inflows during the same weeks. While everyone else was getting out at any price, China was buying at every price level. That is the contrarian trade, right there in the data. And just so we are all oriented on where we actually stand, gold is up approximately 1,568 per ounce on a year-over-year basis right now, even after the full March sell-off. A year ago, gold was around 3,375 per ounce. Today, it is trading in the $4,700 range. That is not a broken asset. That is an asset that went on a temporary sale for reasons that had nothing to do with what makes it valuable. Goldman said it themselves. We expect dip buying from central banks and other physical buyers, ultimately keeping reversals relatively shallow. Screenshot that. Put it somewhere you can find it. ETF flows across the board are turning positive again in April 2026. The dip buyers showed up. The central banks didn't stop. And the structural case is still fully intact. Now let's get into what the research actually says. UBS published multiple notes this week, 4 reasons to stay bullish. Reason 1 is stagflation. Rising prices plus a slowing economy at the same time. Your cost of living goes up while your job security goes down. The Iran conflict is feeding oil costs into everything: food, transportation, manufacturing. And when inflation is still running hot, the Fed can't cut aggressively. So, growth stalls. Gold performs well in stagflation because when both the currency and the economy deteriorate simultaneously, money moves into things that hold value regardless of what governments decide to do. Gold doesn't need a healthy economy to be valuable. That is the whole point. Reason 2, weaker dollar. Dollar index already went from 109 to 99. UBS projects that continues. When the dollar falls, the dollar price of gold rises, mechanically, like a seesaw. Reason 3 is rate cuts. When the Fed has rates at 5%, government bonds pay 5%. Capital stays in bonds, nobody complains. But Goldman Sachs projects another 50 basis points of Fed rate cuts in 2026, which their analysts calculate adds approximately $120 per ounce of price support to gold directly. When yields drop toward 1% or 2%, cash earns almost nothing in real terms, and that capital starts looking for assets that can actually appreciate in value. Gold, which rose over 60% in 2025, starts looking very attractive compared to a bond paying almost nothing. The rate cut cycle already started. 3 cuts in late 2025, more coming. Every cut tightens that comparison a little further. Reason 4, central bank buying. And look, this is the big one. The institutions that literally create money are buying gold. Goldman's research expects emerging market central banks to purchase 60 tons of gold per month in 2026. JP Morgan projects 755 tons for the full year. The World Gold Council says gold now sits at 20% of emerging market reserves. China specifically, 15 consecutive months of buying through January 2026. 15 months. That is not a trade. That is a structural policy shift, with a 15-month track record and no signs of reversing. So, Goldman Sachs. In January, their analysts Don Striven and Lena Thomas raised the bank's year-end 2026 gold target to $5,400 per ounce, up from $4,900, a more than 10% upward revision to an already bullish call. And then March happened, 10% drop, biggest monthly decline since June 2013, and Goldman held 5,400, didn't walk it back, didn't add caveats. Their message was essentially, the sell-off doesn't change the structural case. And here is the detail most people missed. Goldman's $5,400 is the most conservative forecast among the major banks. Goldman's own bull scenario puts gold at $5,700 to $6,100. JP Morgan targets $5,000 by Q4 2026 with $6,000 possible longer term. The UBS chief investment officer published 3 words to clients this week. Stay bullish on gold, not consider gold. Stay bullish. Goldman also named something they call the debasement trade. High net worth families buying physical gold bars. Institutional investors loading gold call options, specifically because of concerns about long-term government debt and monetary policy credibility. This isn't retail speculation. This is sophisticated capital deliberately repositioning ahead of something it sees coming. And you know what? They might be seeing the same thing every person who checks their grocery receipt is seeing. The dollar buys less every month. Prices aren't coming down. And the structural reasons for that are not resolving on any timeline that a savings account can outrun. Let me explain the root cause underneath all of this, because this is the thing that ties it all together. The US government is running a deficit that is getting worse, not better. Europe same. The Iran conflict is adding hundreds of billions more to the spending hole every year on top of what was already a serious problem. So, how do you cover an expanding deficit? You issue more debt. More treasuries flooding the market looking for buyers. But here is the problem developing in real time. The traditional buyers of that debt, foreign central banks, are reducing their purchases. Some are outright selling. So demand shrinks while supply explodes. When the market won't absorb all that new debt, the pressure builds on the Fed to step in and create new money to buy it themselves. That is monetization. That is what money printing actually means in practice. The math is really simple. Imagine all the money in the world fits in this room. Now someone walks in and fills the room with twice as much money. Each individual dollar is now worth roughly half as much in real terms. That is what has been happening to the US dollar, slowly, persistently. The dollar index going from 109 to 99 in 12 months is that math made visible. That 10-point drop, you paid for it. Your savings paid for it. Every grocery receipt you got this year is the evidence. Gold cannot be printed. Its global supply grows by about 1% to 2% per year through mining. No emergency committee meeting doubles gold supply overnight. And that scarcity is exactly why central banks, sovereign wealth funds, and Goldman Sachs' wealthiest clients are all moving toward it at the same time. So let me give you the full picture. Think of financial markets in 3 layers. At the bottom, retail investors, most of us. In the middle, Wall Street, Goldman, JP Morgan, UBS. At the top, the central banks, the entities that create money. Who is buying gold? Central banks, 60 tons a month, 15 consecutive months from China alone. Goldman, $5,400 target held through a crash. JP Morgan, $5,000 by Q4. UBS, stay bullish. Retail ETF inflows turning positive in April. Show me the bear case. Put it in the comments. I genuinely want to see someone explain how every layer of this market is wrong simultaneously, because I cannot find that argument in any of the research. One more thing before the framework. China changed the rules for its insurance industry this year. For the first time, Chinese insurance companies can put 1% of total assets into gold. These companies collect premiums from hundreds of millions of policyholders and invest the float. The 1% slot just opened. UBS says they haven't even finished filling it yet. That is fresh structural demand entering the market right now, not yet fully deployed, not yet fully priced in. Every time I look at a major asset, I ask myself 3 things. Not 10, just 3. And here they are. First, what are the most informed players in the world doing with real money right now? Not what they say in interviews. What the actual capital flows show. Central banks. Buying 60 tons a month, 15 consecutive months from China alone, JP Morgan projects 755 tons for 2026. Goldman, $5,400 target, held through a 10% crash. JP Morgan, $5,000 by Q4. UBS, stay bullish. All of this in the same week, same research cycle, all pointing the same direction. Second, what is the crowd doing, and do I want to be on the same side as the crowd right now? Institutional sentiment near historic lows, leveraged funds liquidating, retail investors panicking out of positions they spent 2 years building. The crowd is selling hard, and historically, every time that has happened with gold over the past 3 years, the average return over the following 90 days was 18%, right? That is not me telling you what to buy. That is just the data. Decide what you want to do with it. Third, are the forces behind this asset temporary or structural? De-dollarization. Dollar index from 109 to 99 in 12 months. Sovereign nations making multi-year policy decisions to reduce dollar exposure. That does not reverse because of one trade deal. Government spending. Every major developed economy spends more than it collects. There is no credible political path to change that. No government in modern history balanced its budget by becoming less popular with voters. This compounds. The Iran conflict. Energy infrastructure damage, supply chain disruption, inflationary pressure, years, not quarters. Central bank gold accumulation, 15 consecutive months from China alone. That is a policy commitment with a 15-month track record, not a trade. These are structural, multi-year, and gold sits at the intersection of every single one of them. Look, the March crash scared a lot of people. That is what 10% drops in 30 days do. They separate the people who understand what is happening from the people who just react to the price chart. Goldman looked at that 10% drop and said $5,400. Still, JP Morgan said $5,000 by Q4. UBS said stay bullish. China bought $1.9 billion in ETFs during the panic. Central banks are buying 60 tons a month. The dollar is at a 10-year low. And every structural force driving this, deficits, de-dollarization, rate cuts, geopolitical chaos, none of it is resolving next quarter. The research is public. Read the Goldman note. Read the UBS report. Links are in the description. And if this was useful, share it with someone who actually needs to hear it right now. See you in the next one.